What's up, YouTube? In this video, we're going to be covering the 5 biggest mistakes to avoid once you cross the $1 million mark in your investments. This is going to be a really important video for you if you already reached this milestone or you're currently working towards hitting that first $1 million in your investments. And these are mistakes I've seen a lot of people make over the years in helping tons of people with their investing and their goals. And these are things I want to make sure that are on your radar, and more importantly, you know how to avoid these mistakes so you can make the most out of the wealth that you're building and reach your goals faster. So let's go ahead and dive in. Mistake number 1 is not paying attention to taxes. Taxes, like inflation, are like a hidden killer of your wealth, especially after you start to reach these larger and larger milestones in your investing, like the $1 million mark, for example, because the bigger that your wealth grows and the more that your income goes up over time, the bigger the impact that taxes can have on your money. And it's really important to start thinking a lot more strategically about this particular subject, maybe even more so than you have in the past, because there's a concept that I share with people all the time, and it's called tax drag, which is a fancy way of saying the impact that taxes can have on your portfolio's returns, or in other words, how much taxes can reduce the amount of money that you're making with your money. And this is a quick study that was done by a company called Morningstar that shows, on average, the impact that taxes can have on your portfolio's returns, or in other words, the amount of money that you can make with your money. And this is over almost a 100-year period, taking into account the impact that taxes had on different types of investments. As you can see here, over this time period, without tax, the returns on stocks in the stock market was around 10.2%. But the after-tax impact, or the return after taxes, was around 8.2%. And that 2% difference, even though it doesn't sound big, it can be a massive, massive difference, especially as your money continues to compound and grow. And we can see a similar type of impact on bonds here, which is another type of investment that you can own. The gross return, or the return before tax, was 5.5% for bonds over this time period, and the net return after tax was around 3.5%. So in both cases, in this scenario, they deduced that the average impact that taxes could have on your returns was around 2% per year. And again, that 2% can make a massive, massive difference, especially as we're talking about larger and larger amounts of money. This is another way of looking at the impact that taxes can have on your wealth, taking into account those percentages that we just looked at. So in this scenario, we're assuming that you're starting off with $500,000. So you're not at the $1 million mark just yet. You're at the $500,000 mark, and you're getting an average return in your investments of 7.5%. And you start off with that $500,000 and you let that grow over 10 years, a 10-year period of time. If you had no impact from taxes, that $500,000 would grow to over $1,031,000. That's no tax impact. Now, if we had a tax impact or tax drag of 1%, instead of the $1 million, you'd have $939,000 over that 10-year time period. And if you had a 2% tax impact, which we just saw is pretty in line with what history shows that taxes can have on your returns in terms of impact, you only have $854,000. So as you can see, even though the percentages don't feel like a big deal, similar to like investment fees in your portfolio, it can have a massive, massive impact. So mistake number 1 is not understanding and not planning around taxes when it comes to your wealth. Mistake number 2, after you've reached that $1 million mark in your portfolio, is getting too greedy. I know it's easy to really start to feel ambitious because you've reached that $1 million mark and you're like, man, I can make that even faster. I can turn 1 million into 2, 2 to 4, 4 to 10 overnight. But this can be a massive, massive pitfall when it comes to your investing. Let me explain why. So there's a concept in investing called portfolio maximum drawdown, which is basically just a fancy way of saying the maximum percentage of losses that your investments take whenever the market goes down or any particular investment in your portfolio goes down. And this is especially important when we start to own riskier types of investments like individual stocks. And I've seen a lot of people make the mistake of reaching the $1 million mark and they start getting greedy and they start putting much more of their money into high risk types of investments. And yes, there is a possibility for higher returns with some of these higher risk investments. But what a lot of people don't think about is the fact that the losses can also be substantial. They can be really big. And as your portfolio grows, so do the losses that you can take on. So a lot of people don't take that into account. And those losses can be devastating. They can be really hard to come back from. Let me give you an example. Here we're looking at Meta stock, formerly known as Facebook, and we're looking at its maximum drawdown over the past 5 years. So the biggest drop that this one stock has taken over the past 5 years. And of course, Meta is one of the top companies in the S&P 500. It's one of the largest companies in the world. And this goes to show you this can really happen to any individual stock. If it can happen to Meta, it can happen to basically anyone. And as you can see here in this diagram, Meta stock fell by as much as 76.74%. Over this time period. So imagine that $1 million being reduced by 76.74% in a relatively short period of time. That's a massive, massive loss. And I can't imagine what that would feel like if almost all of your money was tied up in Meta stock. And that probably, a lot of people that work at Meta probably went through that, because in working with a lot of tech employees, I know a lot of people like to have a lot of wealth in their company stock because it's a part of their compensation. But that's why we have conversations around risk. That's why we have a conversation around diversification. And that's why it's really important to avoid getting greedy, because at this stage, you don't need crazy returns. You really just need consistency of returns, because you finally reach the point in the compounding journey where your money is starting to do a lot of the heavy lifting for you. So that's really important to keep in mind. And one last visual before we move on to the next point here is understanding the concept that the bigger the loss you take on, the harder it is to break even from that point in time. So as you can see here, a drop of 10% in your portfolio requires an 11% return to break even. A 20% drop requires a 25% return from that point in time to break even. A 50% drop requires a 100% return from that point in time to break even. A 70% return requires a 70% drop requires a 233% return from that point in time to break even. And the gap continues to widen. So the moral of the story here is the bigger the losses that you take on, the harder it is to come back from them. And when we're talking about larger amounts of money, if it's 1 million, 2 million, 5 million, not only can those losses hurt, it can be really difficult to dig yourself out of that hole. So moving on to mistake number 3, it is not adjusting your portfolio. You might have heard the saying, what got you here won't get you there. And that's extremely prevalent in investing. That's something I share with my clients and students all the time, especially as they continue to hit these important milestones in their investing journey. So as you hopefully know by now, if you've been watching my videos or you're one of my clients and students, I always like to share a concept called the investing journey. And these are really 3 primary stages that you're going to go through as an investor as you're working towards your goals, whether that's financial freedom, retirement, generational wealth for your family, or any combination of those things. When you're first getting started, you're in what's called the accumulation stage. This is where you're building your wealth from scratch. This is where you're being most aggressive with your investments and taking the most risk, because you are needing to experience growth and you have time on your side. If we do see a drop in the market, if we do see a drop in your portfolio, it's something that you can come back from. However, once you cross that $1 million mark, and this is relative because it depends on your situation and goals and all that good stuff, but typically, once you cross that $1 million mark, you're no longer at the starting point of your investing journey, which means you shouldn't be treating your investing exactly the same as how you were in year 1 or year 5 or whatever it was when you were still in the wealth building stage, because now we're starting to shift from a wealth building to more of a wealth preservation. Of course, we're still growing the wealth, but it's not as much of an aggressive push to really get this thing off the ground, because our portfolio is already off the ground. Now it's making sure it doesn't crash and burn while it also continues to grow at a good enough pace to help us reach our goals. So this is just a quick example of what this can look like. This is what's called asset allocation. If you don't know what that means, it's just different types of strategies that you can follow with your investments based off of risk and return. The one all the way to the left is considered aggressive growth, meaning you're primarily stocks in your portfolio, 90% stocks, if not more, because again, you're focusing on growth. And again, that can be fine if you are just getting started. Maybe your portfolio isn't super large yet, and you're just focusing on growth, and you can weather any ups and downs in the market. However, as your wealth continues to grow, and as you get closer to actually needing the money for whatever goal that you're investing for, it's important to consider starting to scale back some of that risk and focus less on what's the most amount of money that I can make, and more to how can I protect this amount of money that I've built over all these years, while also still making sure that it's growing at a pace enough that is in alignment with the amount of money that I'm going to need to reach my goals long term. So not making adjustments to your portfolio is a very big one. Mistake number 4, this goes hand in hand with the other mistake that we talked about earlier of being too greedy, is not being diversified enough. So if you don't know what diversification means, the simplest way I can explain it is really just not having all your eggs in one basket, not having all of your money in one individual stock or even one part of the stock market. And this is a visual that I share with clients and students all the time. I know there's a lot going on here. You can feel free to look this up after the video if you want to take a deeper dive into it. It's called the asset returns quilt. But in any case, what we're looking at here are the different returns for different types of investments, different parts of the market, and in this case from 2008 through 2022. So a good period of time here. The tile or the color at the top represents the type of investment that had the highest return for that year, and the tile at the bottom represents the investment that had the lowest returns or lost the most money in that particular year. And as you can see, there's a white tile, and that represents a diversified portfolio. So why am I showing you this? Well, the purpose of diversification isn't to make the most amount of money possible, and it's also not to guarantee against losses, because diversification doesn't necessarily guarantee that you won't lose money. The point of diversification is to put yourself in a position to avoid catastrophic losses, which we just talked about can really set you back on your journey towards your goals. So a diversified portfolio, the purpose of it is to avoid, put yourself in a position to avoid massive losses while still capturing some of the growth of the market and focusing more on consistency of returns rather than what's the most amount of money that I can make. Because again, I'll emphasize, at the $1 million mark and above, your portfolio is going to start doing a lot of the work for you because of how compound interest works. Again, the analogy, 10% on $1,000 is $100, 10% on $100,000 is $10,000, right? So hopefully this is connecting your brain here a little bit. But again, after the video, you're welcome to check this out. This is called the asset returns quilt, and it really paints a clear picture as to the value of diversification. And then mistake number 5, I think the biggest one here, is investing without a clear financial plan tied to very specific goals. And the more that your wealth grows, the closer you get to actually expecting to need that money, whether it's for financial freedom, whether it's college for your kids, whatever the money you're trying to invest and build wealth for, it becomes much more important for you to have a very laser clear, rock solid plan that helps you understand, am I on track? Am I doing enough? And am I making sure that I'm not putting myself in a position to fail? So the analogy that I share with clients and students all the time when it comes to a financial plan is it's really like a GPS for your investments, for your finances, and for your financial future. Just like when you get into a car and you turn on your GPS, it tells you where you're at right now, point A, and it tells you where you're trying to go, point B, your goals when it comes to your finances. And it helps you develop the most efficient route to getting to that goal or that destination on time. And it also helps you understand, if I get off course, how do I get back on track? So a great financial plan answers so many questions, and these are just a couple of them, but these are just some that I want you to walk away from our video today thinking about when it comes to your personal situation. But a great financial plan helps you understand, how much wealth do I really need to reach my goal? You might feel good about the fact that you've already reached the 1 million, and that's great, but is that 1 million going to be enough? Or do you need to focus on continuing to grow that amount? Am I currently on track to reaching the goal? Am I investing enough currently? Are my investments in alignment with where they should be? Am I thinking about taxes properly? Do I have the right investment accounts set up? How do I reduce the odds of running out of money? Right? And this is a big one because a lot of people make the mistake of building a good amount of wealth in their portfolio, and they decide to make work optional or just step away from work completely, but they don't have a plan to make that money last. 5-10 years pass, they run out of money, and they're back at square one all over again. And this can be easily avoided by some careful financial planning in the beginning. What adjustments do I need to make over time? So we talked about making adjustments to your portfolio. A good financial plan helps you understand, when does it make sense to start scaling back some of the risks that I'm taking? When should I be thinking more strategically about adjustments to my strategy? And of course, how do I protect the wealth that I built over time? We talked about taxes earlier. Inflation is another thing to keep in mind. There's all sorts of things that can be threats to the wealth you work super hard to build in your investment portfolio. And these are just a handful of the different questions that a good financial plan or a good financial GPS helps you get answers to. And this is just a quick screenshot of an example of what this could look like. This is just one page out of a large financial planning document that I created for one of my personal one-on-one financial coaching clients. But you can see there are different accounts listed, different balances in the accounts, planned contribution amounts, how much we're planning on contributing to the accounts, and so on. So this is just a quick snapshot of just one step of that process. So those are the 5 biggest mistakes to avoid if you've already crossed that $1 million mark in your investment portfolio or are on your way to it. I want to make sure that these are on your mind as you're working towards that goal, because it's important to understand what lies ahead of your journey. And if you're watching this video, whether you've reached that $1 million mark or not, and you're just not sure if you're doing things correctly, you're not sure if you're on track, you're not sure if you're investing enough, you're not sure if you're building enough wealth or if it's going to last, or any of the things we talked about so far in our conversation today, and you'd like some guidance, next steps from here are simple. In the description to this video and in the comments as well, I'm going to leave a link that you can use to schedule a quick free one-on-one consultation with myself. That's an opportunity for us to sit down, help me understand more about your situation and your goals, see where you're trying to get, and see how I can point you in the right direction and provide you some guidance to make sure that you are on track and have answers to all those questions that might be keeping you up at night as relates to your finances and investments. So again, the link to schedule that quick one-on-one meeting is going to be in the description to this video. I'll also leave it in the comment section of this video as well. But I hope you've found this video helpful. Hopefully it gives you something to think about. Hopefully it gives you something to start applying right away in your investing and your finances. If you found this video helpful, make sure you give it a thumbs up. Leave a comment down below letting me know what you found the most helpful. And again, if you need some help on this investing journey towards your goals, I'd love to have a conversation with you. Use that link in the description or in the comment section to schedule a time for us to meet, and we can take it from there. But that's going to be all for me in this video. Hope you found it helpful. Thanks for watching, and I'll see you in the next one.